Lending by financial intermediaries falls into two broad categories, what I classify as demand-side financing and supply-side financing. Demand-side financing normally refers to providing loans for consumption demand. For example, individuals go to a financial intermediary to source a loan to buy a home, to buy an automobile, etc. So demand-side financing, as you've figured by now, is shaped in any economy by the citizens of that country. Supply-side financing, on the other hand, refers to the funding requirements of companies that produce goods and services such as steel, cement, automobile, soaps and toilet items, etc., all meant to fulfill consumption demand. Such entities too need to go to financial intermediaries or to the corporate bond market to source funds to expand capacity, to produce more, to fulfill the increasing consumption demand. So supply-side financing, as you have figured by now, is created in any economy by the firms and businesses operating in that country. Financial intermediaries, therefore, have to cater to the demand-side financing, which is meeting the financial needs for consumption by households and individuals, and supply-side financing, which is financing required by companies and firms to produce more goods and more services. Most loans given by financial intermediaries are secured in some form or the other, but some loans are also unsecured. Unsecured means the financial intermediary has no recourse if the borrower fails to meet his or her repayment obligation. How are loans secured? In at least four ways. First, as a pledge. A pledge is a form of collateral-based lending where the assets given as collateral to obtain the loan is in the custody of the lender. Example, say you're in dire need of a short-term loan, so you go to a prospective lender and say, here is my gold chain, keep it with you, and in turn give me some money for the short term. I will pay you back with interest at the end of the agreed time period. The gold chain in this case is pledged to the lender. When you return the money to the lender, he will return the gold chain back to you. If you fail to repay, he will sell the gold chain you have given him as collateral and settle the outstanding loan amount. In short, in a pledge, the underlying asset that is given as a collateral to get the loan is in the custody of the lender until the loan is fully repaid. In a mortgage, on the other hand, the asset that serves as the underlying collateral is in the possession of the borrower. Take the case of a mortgage loan that you take to buy a home. You are living in that home, but the home is mortgaged to the bank. In a mortgage, therefore, the asset that serves as the collateral for the loan is put to use by the borrower, unlike in a pledge where the asset which is used as a collateral is in the custody of the lender. And then we have assignments, which are charges created on assets. For instance, if a firm has receivables that are to be realized, say 30 or 60 days hence, they are assigned to the financial intermediary by the beneficiary of the receivables to raise funds at a discount today itself. When the payment against the receivable is realized, say 30 or 60 days hence, it is used to pay off the loan. A lien. Say you have a certificate of deposit or a fixed deposit for 90 days maturity. You could use that as a security to get a loan today for a period of say 30 or 60 days. The CD or the FD in this case is held under lien by the financial intermediary. If you fail to repay the loan, the CD or the FD is liquidated and the loan is settled. And finally, set off. Banks can use debt obligations of its borrowers to set off an outstanding loan. For example, A bank has given a loan to an exporter to produce and sell his goods overseas. When the goods are sold and the cash is realized, the money so realized will immediately and automatically be used to settle the outstanding loan. As you would have figured by now, there is an enormous responsibility on the financial intermediary to appraise the loan before the money is disbursed. Do remember, some loans could be for a very long duration. For example, a long-term loan, also called project finance, to build a factory or a power generation plant could involve repayment for up to 15-20 years. Hence, the risks involved in project finance are significant, and financial intermediaries adopt their own methods to assess the risk in such lending. A variant of project finance is syndicated lending. In some countries, it is called consortium lending. In syndicated lending, a group of financial intermediaries come together either because the loan amount involved is very large, or the lending could be cross-border. That means the borrower is located in another country. Consequently, the associated risks are far more significant. Hence, banks tend to come together as a syndicate to provide these kind of loans to not only share the burden of the loan amount, but more importantly, to share the associated risks as well. Working capital is usually given by financial intermediaries as an overdraft. So if you need the money, you draw against it. If you don't need the money, don't draw against it. There is one other aspect called non-fund based services offered by financial intermediaries that we will discuss in the next session.